Hi, welcome back to our class. In the last video, we have discussed the motivation behind corporate contractions. In this video, we will be introducing asset sell-offs, which are also known as divestitures. A divestiture is the sale of a portion of the firm's assets to a third party in a private transaction. The assets sold may be a division, segment, subsidiary, or product line. In return, the seller typically receives cash, but sometimes also securities or a combination of both. The proceeds from the sale are reinvested in the remaining business or distributed to the firm's claim holders. While some assets are sold, the selling firm continues to exist. If the seller receives cash, divestitures may trigger a substantial tax liability. If the proceeds from the sale is higher than the book value of the respective assets, the difference is a capital gain, and capital gains are taxed at the corporate tax rate. In our last video, we have discussed how these economies of scale and diversification discounts may motivate a company to downsize. In the case of divestitures, another motivation to carry out a divestiture is to raise cash. For example, in year 2011, Fujian Furil Electronics sold 100% shares of its real estate subsidiary for 80 million Chinese yuan. The company announced that the proceeds will be used to repay bank loans and increase liquidity so as to improve our performance and financial status. Another potential reason for firms to engage in divestitures is regulatory requirements. For example, central state-owned enterprises of China were required to retreat from real estate industry in 2011, so they had to divest their real estate subsidiaries. Asset sell-offs or divestitures are generally shown to increase shareholder value. Upon corporate announcement of divestitures, the share price of the selling firm tends to outperform the market. Academic research from the 1960s to the 1990s presents a clear pattern of positive shareholder wealth effects to the seller. A positive stock price reaction to seller may be attributable to various reasons. First, the targeted assets may be more valuable to the buyer than to the seller. That is to say, the seller disposes the asset at a premium to its own valuation of the targeted asset. Secondly, investors may like a selling transaction if the proceeds can be used to develop the seller's core business. Next, studies also show that investors may also react favorably if cash received from a divestiture could be used to pay dividends, repurchase stocks, or repay debt. Asset sell-offs can be a big event for a company. A seller may turn to investment bankers for financial analysis as well as for the execution of a sale. The sell-side team of investment banks can provide comprehensive analysis on pricing and the consequences of a sale. The bankers can also assist the sellers to balance selling price, confidentiality, and the speed of execution. If a seller prioritizes selling price over timing and confidentiality, a broad auction can be organized to reach out to as many potential bidders as possible. If a seller is concerned about timing or confidentiality, the M&A bankers and the coverage bankers can reach out to potential buyers privately or organize a targeted auction among their selected range of buyers. If a bidder can offer a price higher than the selling company's valuation of the targeted asset, a sell-side deal can move on. For public companies, they may also need investment banks to provide a fairness opinion to demonstrate the selling price is fair from a financial point of view. The reason to use a fairness opinion is to protect company board and its management. This practice can be tracked to the acquisition case of TransUnion by Marmon Group. In year 1981, Marmon Group bid a cash offer to buy TransUnion at a price of $55 per share. The price was at a 14.8 premium to the market price of TransUnion. The management of TransUnion agreed to the offer price without consulting external experts, and the board of TransUnion quickly approved the merger. Later, TransUnion was sued, and the court decided that there was no evidence that $55 per share represented the per-share intrinsic value of the company, and the board of TransUnion were held liable for their negligence. Ever since the TransUnion case, it has become common practice for a U.S. company to obtain a fairness opinion in M&A transactions. Fairness opinions exist as external financing experts consent to fair valuation of the target. Although divestitures are generally shown to increase shareholder value, the premise is that corporate management acts in the best interest of shareholders when selling assets. The requirement of a fairness opinion may also help to mitigate potential agency issues in asset sales. For example, selling an asset at a price lower than its intrinsic value. The practice of obtaining a fairness opinion has not been a universal standard across different markets. On this slide, we have a case study of agency issues in divestitures in the market of China. In year 2004, China Petroleum and Chemical Corporation, CPCC, sold 75% shares of its real estate subsidiary, Taishan Real Estate, to SWUFE Investment. The deal was priced at around 123 million Chinese yuan. The interesting story is that only 2 months later, SWUFE Investment resold Taishan Real Estate to another party, but for 325 million Chinese yuan. The selling price had a shocking difference of 200 million Chinese yuan. So we can see Taishan Real Estate had been underpriced when it was sold to SWUFE Investment, and shareholders of CPCC lost around 200 million. Further investigation revealed that the chairman and general manager of CPCC, Mr. Chen Tonghai, was connected with SWUFE Investment and took the 200 million. And Mr. Chen was put to jail because of this criminal offense. From this case, we can see the importance of fair valuation of a target in asset sell-offs. If fairness opinion from an external financial advisor had been required by shareholders, it may be more difficult for management to sell assets at their selected prices and tunnel shareholder wealth. Okay, in this video, we have discussed divestitures or asset sell-offs, and we know divestitures are usually shown to increase shareholder value. But the premise is that the management acts in the best interest of shareholders, and we have discussed the use of fairness opinion and potential agency conflicts in asset sell-offs. Thanks for watching. In the next video, we will proceed to discuss spin-offs and split-offs.